Managing mortgage payments efficiently is essential for maintaining financial stability and achieving long-term homeownership goals. In this video, we'll explore 5 effective strategies to lower your mortgage payment. So make sure to leave a comment below if you know of another strategy that I don't mention in this video, or you have more questions about the strategies I do mention. So let's talk first about paying points. Now, your parents might have told you never pay points, never pay points. Well, maybe in the past that might have made sense, but paying points in a lot of cases, especially right now when rates are higher, makes a lot of sense because it helps you qualify for a mortgage when you may not have otherwise qualified, at least for the price point that you're hoping to look in. So points, also known as discount points, are prepaid interest fees that you can pay up front to reduce the mortgage interest rate, which in turn reduces your monthly payment. And each point is going to equal 1% of the amount you're borrowing, and on average would save you about 0.25% on your interest rate. So for an example, if you were qualified for a 7% interest rate and you paid 1 point and it was lowered by 0.25%, that would mean that you went from 7% to 6.75%. That's a 0.25% reduction. Now, on a $400,000 loan over 30 years, that reduces the payment by only $66. Not a huge number. However, over 30 years, that's actually $24,000 that you're saving on the loan by paying that discount point. So in this example, you paid 1% of $400,000, which is $4,000, to save $24,000, meaning that your net savings, $24,000 minus your cost of $4,000, is $20,000. That's a lot of money. So if you're planning to keep the property long term, it makes perfect sense to pay the point, especially if paying that point helped you qualify for a property when you may not have qualified otherwise. Now, other benefits to that are it lowers the interest rate, and it can significantly, in some cases, reduce the mortgage payments. Now, $66 wasn't significant, but there are cases where it might be more substantial than that. And you can pay more than 1 point to get more savings because there's no rule of thumb on what you save based on the point. I was just giving you a general average that 1 point saves about 0.25%. But depending on the market, 1 point could save 0.75% on the rate. And if that were the case there, I mean, you're saving $190 a month by paying the 1 point. It's even more advantageous, right? So you kind of need to see where the market is at any given time and whether or not you need to pay points in order to qualify, because you may not qualify without doing so. And paying points up front on top of that becomes a tax deduction because it's mortgage interest, and mortgage interest is tax deductible when you file your tax returns. Now, that's number one. Number two, another way to reduce your monthly payment is with a temporary rate buy down. Now, a temporary rate buy down means that you're reducing the interest rate for a set period of time, which is different than paying discount points. Discount points reduce your rate for the entire length of the loan. If it's a 30-year mortgage, your rate's reduced for 30 years. On the other hand, a temporary rate buy down reduces your interest rate for a set period of time. And it's going to require you to pay upfront fees the same way points do, but it's going to save you more initially, but not over the life. So a temporary rate buy down involves paying additional upfront fees to the lender that temporarily reduced the rate on the mortgage for the specified period of time, as I mentioned, which is usually 2 to 3 years of that loan term. It makes the most sense if you can get a seller credit when you're negotiating your purchase agreement and have them pay for the temporary rate buy down. And the reason I say that is because the amount of money you save with a temporary rate buy down is the exact amount of money that it costs for that temporary rate buy down. So if you're paying the money to buy the rate down temporarily, it's a wash. You know, maybe in your mind you're paying less monthly, so it feels better. But if you're paying the money to reduce the payment by the same exact amount you're saving monthly, you're not really saving anything. So just keep that in mind. The reduced interest rate gradually increases over the term. So if you're getting a 2-year buy down, for example, your rate's 2% lower the first year. So if it was supposed to be 7, it's now 5. The second year, it goes up by 1%. So it would be 6. And then from year 3 through 30, it goes to the original 7%, which was the original rate you were expecting to receive on that mortgage had you not gotten a temporary rate buy down. Now, these can provide immediate relief by lowering the initial monthly payments, making homeownership more affordable during the early years of the loan. So maybe you're someone that is buying your first home, you just starting your new job out of college, right? So you're trying to get acclimated to home ownership. You've never, paid rent. Maybe you used to living with your parents or living in a dorm, and so you're not used to that. Well, it's a great way to, gradually get into the housing market, get used to making housing payments or, just having a monthly housing expense that you did in the past. It's useful for buyers who expect maybe their income to increase in the near future, or even if you plan to refinance in the short term, it's a great way to have a lower monthly payment and some reprieve in the initial years of home ownership ownership as you lead into the time that you're going to refinance when rates eventually drop. Now, another way to lower your monthly payment is just to do a longer loan term. So maybe you add a 15-year mortgage, or you're looking at a 15-year mortgage option, but you know what? You want a lower monthly payment, so you decide to go with a 30-year mortgage. Now, the longer loan term is typically going to have a slightly higher interest rate, but because it's stretched out over a longer period of time, the monthly payment's going to be lower. It's going to make the property more affordable. And so while this strategy may result in paying more interest over the life of the loan, it could provide a short-term relief for borrowers who face financial constraints. So extending the loan term is a great option. Extending the loan term, it can significantly reduce the monthly payments in some cases, especially if you're comparing it to a 15-year or a 10-year, and it makes homeownership more affordable. It just eases the financial strain. The lower monthly payments can free up cash flow to use for other expenses, maybe even help you save some money, just improve your overall financial flexibility, which is huge. Now, if you already own the property, well, you want to refinance. I mentioned using a temporary rate buy down and then keeping that until you get to the point where you can refinance because rates have gone down, or maybe you've gained more equity in the property. And so what it means to refinance is you're replacing your existing mortgage with a new mortgage that typically offers better terms, like a lower interest rate. So refinancing can be beneficial when market rates drop, or when borrowers' creditworthiness, maybe, at the time that you got your loan, your credit was lower, so you result in a higher interest rate, or you did an FHA mortgage because you didn't have enough money for a down payment using conventional, right? There's a multitude of reasons why, but maybe your credit improved and now you're able to go ahead and get a conventional mortgage at a lower interest rate than what you were able to obtain previously. Or maybe you only put down 5% initially and now you think you have enough equity to eliminate the mortgage insurance, plus rates have come down, right? There's various reasons why, but a refinance is a great way to lower your monthly payments and save monthly. Now, lowering your interest rate through refinancing can substantially reduce your monthly mortgage payments, as I said, and it's going to give you savings over the life of the loan. And as I already said as well, just keep in mind that mortgage insurance is huge. If you can eliminate your mortgage insurance when you refinance, well, that's going to reduce your payment even further, even if your rate happens to stay the same. And another way to reduce your monthly payment, right? Really simple. And this, wow, of course, is borrow less by putting more money down. Pretty simple. If you're in a position to make a larger down payment at the time of the purchase, it's going to reduce your loan amount. It's going to give you a lower monthly payment, right? You're borrowing less, you're paying less. Now, while saving for a larger down payment may require more time and discipline, it can lead to considerable savings over the life of the loan. You've seen me do examples of 5% versus 20%, and the difference that it can save you a couple $100,000 over 30 years. And in some of those cases, depending on the amount of money that you're borrowing. So it's more difficult to save the money, but you're naturally going to have a lower monthly payment. You're going to save money over time if you're in a position where you can put down a larger down payment. And the larger down payment is going to decrease the loan amount, as I mentioned, reduces the payments. 20% would eliminate the need for mortgage insurance, as we've already talked about, right? We know that mortgage insurance on a conventional loan is required anytime you're putting less than 20% down. So if your down payment is 20% or more, you're not going to have to pay that mortgage insurance. So once again, on top of just putting more money down, borrowing less, if you're putting enough down to not need mortgage insurance, you're saving even more on a monthly basis, because the goal here is to get the lower monthly payment. Now, lower monthly payments resulting from a higher down payment improve your overall affordability and financial stability and reduce the risk of a mortgage default. So implementing these strategies can help you lower your mortgage payments, improve affordability, and achieve greater financial flexibility, whether through it's paying points, temporary rate buy downs, extending the loan term, refinancing, or just increasing your down payment. You have various options to tailor your mortgage payments to fit your financial goals and your circumstances. So consider consulting with a mortgage advisor to determine the most suitable strategy for your specific needs, and subscribe to my channel for more videos just like this one.